and welcome to the Property Wealth Podcast. We're excited to have you with us today. If you're over 40 and looking to dive into real estate investing, or maybe you're already in it but want to sharpen your skills, you're in the right place.
Absolutely, Sarah. Today we're diving into something super practical. How to analyze a rental deal in just 10 minutes. I mean, who doesn't want to streamline that process?
Right? It's all about making informed decisions quickly, especially when the market can move so fast.
Exactly. We'll be talking about key metrics to look out for, red flags that might pop up, and how to trust your gut without getting caught up in analysis paralysis.
And we'll share some real-life examples so you can see how these tips play out in the real world. It's all about making real estate investing relatable and achievable, no matter where you're starting from.
Plus, we'll touch on the importance of understanding the local market. It's not just about the numbers, but also about the neighborhood vibe, right?
Yes, definitely. So get comfy, grab a notepad if you'd like, and let's get into the nitty-gritty of analyzing rental deals.
Sounds good. Let's jump right in. You know, Sarah, when we talk about analyzing rental deals, it's not just about the numbers on a spreadsheet. It's really about understanding why this matters, especially for folks over 40.
Absolutely. I think that's such a crucial point. A lot of our listeners might be thinking, what does this have to do with me? Well, you've got retirement timelines that are getting closer, right?
Exactly. And with each passing year, it becomes more critical to ensure your investments are working for you. You want to make sure you're not just treading water, but actually building something substantial for your future.
Right. And with inflation hitting so many people's wallets lately, rental properties can be a buffer against that. I mean, rents often rise with inflation, right?
Yes, that's a big one. You're kind of hedging against inflation. If you own a rental, you can adjust your rents to keep up with rising costs. It's like having a built-in mechanism to protect your wealth.
I remember chatting with a listener who shared that he was worried about his retirement savings not keeping pace with inflation. He invested in a couple of rental properties, and now he's feeling a lot more secure.
That's a great example. And you know, it's not just about the money you're making right now. It's also about what you're building for your family in the long run.
Yes. Wealth transfer is a huge consideration, especially as we age. You want to leave something behind for your kids or grandkids, right?
Exactly. Real estate can be a fantastic vehicle for that. It's tangible. It's something the next generation can appreciate and benefit from. I've seen families who invest together, and it creates this legacy.
So powerful. Plus, there's that emotional aspect too. Knowing that you're securing your family's future can really give you peace of mind.
Right. And let's not forget about the current economic trends. You know, we've seen a lot of market shifts recently, and having real estate in your portfolio can provide some stability.
Yeah, markets can be volatile, but real estate tends to provide that long-term growth. It's less about the daily fluctuations and more about the overall trajectory.
Exactly. And for someone over 40, that long-term perspective is key. You're looking at how these investments will perform over the next decade or two, not just the next quarter.
It's about setting yourself up for success, not just in terms of finances, but also in terms of lifestyle. Imagine being able to retire comfortably, knowing you have those rental properties generating income.
That's the dream, isn't it? And it's entirely achievable with the right approach. When you analyze a rental deal effectively, you can make smarter decisions, and that gives you confidence.
Speaking of decisions, I think it's important to highlight that it's not just about crunching the numbers either. It's about understanding the market, the community.
Absolutely. I once worked with a couple who were considering a property in a neighborhood that was rapidly gentrifying. They were initially hesitant about the price, but after analyzing the potential growth and rents, they decided to go for it.
And how did that turn out for them?
Well, they've seen their property value almost double in just a few years. Plus, their rental income has increased significantly as the demand in that area grew. They're now set up for a much more comfortable retirement.
Wow, that's such a great success story. It really illustrates how important it is to analyze deals properly.
Exactly. And that also shows how being informed and proactive can make a huge difference. If they hadn't taken the time to analyze the deal, they might have missed out completely.
So true. And I think sometimes people over 40 might feel overwhelmed by the idea of real estate investing. It can feel like a young person's game, but it's really for anyone willing to learn and engage.
Absolutely. It's never too late to start investing, and with the tools and resources available today, you can learn quickly and effectively. The key is to take that first step.
Right, and understanding why this is important now. It's about taking control of your financial future and creating a safety net for yourself and your family.
Well said. It's about being proactive, not reactive. And by analyzing rental deals in just a few minutes, you're equipping yourself with the knowledge to make informed decisions.
So how do we get into the core strategies for analyzing those deals?
Good question. We can dive into the key metrics, how to evaluate a property's potential, and what to look for in the market. So let's dive into some core strategies for analyzing a rental deal. One of the first things I recommend is the 1% rule.
The 1% rule? Right, that's where the monthly rent should ideally be at least 1% of the purchase price, correct?
Exactly. So if you're looking at a property that costs, say, $200,000, you'd want to see if you can rent it for at least $2,000 a month.
That's a simple way to gauge whether a property could be a good investment. But what if the rent is like $1, $800?
Well, it doesn't mean it's a bad deal. It just means you should dig a little deeper. You could still consider it if there's potential for appreciation or if the area is up and coming.
That makes sense. So the 1% rule is more of a guideline, not a hard and fast rule?
Right. It's a starting point. Then you can apply the 50% rule, which is another handy guideline.
The 50% rule, that's about estimating your expenses, right?
Exactly. You assume that about 50% of your rental income will go towards operating expenses, including things like maintenance, property management, and taxes.
So if you're making $2,000 a month in rent, you'd estimate about $1,000 for expenses.
That's it. So if your mortgage is $1,200, you'd be in the red. But if it's $800, then you're looking at a positive cash flow, which is great.
It's like a quick way to see if a property is viable or not.
Exactly. And then there's a cap rate to consider.
Ah, the cap rate. That's the capitalization rate, right?
Yes, it shows the return on investment based on the property's net income. The formula is pretty straightforward. Divide the net operating income by the property's purchase price.
So, if a property generates $24,000 a year in net income and you bought it for $300,000, the cap rate would be?
You'd take $24,000 divided by $300,000, which gives you an 8% cap rate.
Got it. And an 8% cap rate is generally considered pretty good, right?
Yeah, anything above 6% is typically viewed favorably, but again, it depends on the market.
I see. So if you're looking at properties in a hot market, lower cap rates might be acceptable since appreciation could offset that.
Exactly. It's all about the balance between cash flow and potential appreciation.
So let's talk about a checklist for evaluating deals. What are the key things you look for?
Well, first, you want to know the location. Is it a good area? Are there amenities nearby, like schools, parks, or shopping?
And what about the condition of the property itself?
Right. Assessing the property condition is crucial. You need to check for any repairs or updates needed. I always recommend getting a professional inspection before making any commitments.
That makes sense. And what about the local rental market?
Absolutely. Research the local rental rates and vacancy rates. You want to ensure there's demand for rentals in that area.
So you're basically doing your homework to understand the market dynamics.
Exactly. And don't forget to analyze the financing options available.
Financing can really make or break a deal, huh?
For sure. Look into different mortgage types, interest rates, and terms. A lower interest rate can significantly affect your cash flow.
And sometimes people overlook how much those small differences can add up over time, right?
Absolutely. Even a 0.5% difference in interest can mean thousands over the life of the loan.
So what type of properties do you find work best for rental investments?
Well, single-family homes are often a good starting point for many investors, especially for those just getting into the market. They tend to be easier to manage.
And they generally have a larger pool of potential renters, I imagine.
Exactly. But multifamily units can also be a great option. They can provide better cash flow and are often less risky because you have multiple tenants.
Right, but they can also come with their own challenges.
Definitely. More tenants mean more management, but it can also mean more consistent income.
That's a trade-off you have to consider.
Exactly. And then there's new construction versus older properties. New builds might be lower maintenance.
But they can be more expensive up front, right?
Yes, and they may not have the charm or character of older homes. Sometimes older properties can be renovated to increase value.
So it's about finding the right balance based on your goals.
Absolutely. And remember, a good deal is not just about the numbers. It's about the overall strategy that fits your investment goals.
Speaking of strategy, are there common pitfalls investors should be aware of when analyzing rental deals?
Oh, definitely. One common mistake is underestimating expenses.
Like thinking repairs will be minimal when they could end up being significant.
Exactly. You should always budget for unexpected repairs and vacancies.
That's really important. Anything else?
Not really considering the long-term implications of your investment decisions is another pitfall.
So focusing too much on short-term gains and not thinking about the future.
Exactly. It's crucial to think about how the property will perform in the long run, especially in different market conditions.
I guess that leads to the overall strategy you mentioned earlier, right?
You got it. It's about aligning your investments with your long-term financial goals and being adaptable as the market changes.
This has been super insightful, Mike. I think our listeners will find these tips really helpful as they analyze their next rental deal.
So, one of the biggest pitfalls I see with new investors is over-leveraging. They get so excited about a property that they take on way more debt than they can handle.
Yeah, that's like the classic rookie mistake, right? I mean, it's easy to get caught up in the potential of a deal and forget about the financial strain.
Exactly. I had a client once who bought a duplex, thinking they could handle the mortgage by renting out both units. But they didn't account for vacancies, repairs, or, just life happening. They ended up stretched thin.
Oof, that sounds tough. So what happened next?
Well, they had to dip into their savings to cover the mortgage when one tenant moved out. And then, when they finally found new tenants, they were not exactly ideal.
Bad tenants? That's another biggie, isn't it?
Absolutely. I mean, it's not just about the rent, right? Bad tenants can lead to property damage, late payments.
And even legal headaches.
Right. This particular client ended up with a tenant who was consistently late on rent. And when they finally had to evict them, it took months to sort out. All that time and money lost.
So it's like a domino effect. One bad decision leads to another.
Exactly. And it's why I always stress the importance of screening tenants properly. Checking credit, rental history, and even doing a background check can save you a lot of heartache down the line.
That makes so much sense. And what about cash flow? I know that's something you've mentioned before.
Yeah, ignoring cash flow is another common mistake. Some investors focus too much on the property's appreciation potential, but cash flow is what keeps you afloat month to month.
Right. If you're not bringing in enough to cover expenses,
you're in trouble. I had another client who bought a property thinking it was a steal because it was under market value. But they didn't do their homework on the area's rental rates. The rent they could charge barely covered their mortgage.
Wow. That's a hard lesson to learn.
It really is. And that's where understanding your local market comes into play. You need to know what similar properties are renting for.
So what's the key to avoiding that pitfall?
Well, I always say run the numbers thoroughly. Know your expenses, and then see what you can realistically expect in terms of rental income. And then always have a buffer for unexpected costs.
Which brings us to hidden costs. What kind of things should investors be on the lookout for?
Good question. Many people overlook things like property taxes, insurance, maintenance, and even management fees if you're hiring someone to help. These can add up quickly.
Yeah, and I bet those costs can really eat into profits if you're not prepared.
Exactly. I knew an investor who was so focused on the purchase price that they didn't consider the annual property taxes. They were blindsided when they got their first bill and realized it was a lot higher than they had estimated.
Ugh, that's frustrating.
It is. And it's all about doing your due diligence up front. Get a good estimate on those costs before you even make an offer.
And timing the market. That's another tricky one, right?
For sure. A lot of new investors try to time their purchase based on market trends, thinking they can buy low and sell high. But the market can be unpredictable.
Yeah, it's like trying to catch a falling knife.
Exactly. I had someone who waited for what they thought was the perfect buying opportunity, only to find out that prices continued to rise, and they missed out on several great deals in the meantime.
That must have been so frustrating for them.
It was. And it's an important reminder that the best time to buy is usually when you find a good deal that meets your criteria, not just because you think the market is at a low.
So how can investors spot these red flags early on?
Well, I think it comes down to being diligent and thorough. When you're looking at potential properties, pay attention to the numbers and don't rush the process.
Trust your gut, right?
Definitely. If something feels off, or if the numbers don't add up, dig deeper, ask questions, and don't be afraid to walk away if it doesn't feel right.
That's such a valuable takeaway. So after making mistakes like these, what's the best way to recover or avoid them in the future?
Well, first, learn from your mistakes. Every setback is a lesson. Analyze what went wrong and adjust your strategy moving forward.
And getting educated is key too, right?
Absolutely. Attend workshops, read books, or even find a mentor who can guide you. It's about building a solid foundation of knowledge.
That makes so much sense.
And always stay flexible. The real estate market can change, and being adaptable is crucial for long-term success.
Yeah, it's like being on a roller coaster sometimes, right? Just gotta hang on and enjoy the ride.
Exactly. And remember, investing in real estate is a journey. It's not just about the destination.
Well said, Mike. Thanks for sharing these insights.
All right, so let's dive into some immediate steps that anyone can take right now to start analyzing rental deals.
Yeah, I think that's super important. What's the first thing you'd recommend?
Well, the first thing I'd suggest is to get comfortable with a few key tools. You know, there are some great apps out there that can really streamline the process. For instance, have you ever used the BiggerPockets calculator?
I've heard of it. It's supposed to be pretty user-friendly, right?
Exactly. It allows you to plug in numbers quickly and gives you a solid overview of potential cash flow, ROI, and more. It's really a fantastic resource for beginners.
That sounds like a must-have. What about other tools?
Another one to consider is DealCheck. It's similar, but it offers more features, like the ability to analyze multiple properties at once. Plus, you can track your deals and even collaborate with partners if you have any.
Oh, nice! So you can keep everything in one place?
Yes, and it's really handy for comparing different properties side by side. And then there's Rentometer, which can help you gauge rental prices in a given area. This is essential for making sure you're not overpaying for a property.
That's really useful. I've definitely seen people get tripped up on rental prices.
Exactly, and if you have access to your local MLS, that's a gold mine for real-time data on property listings, historical sales, and neighborhood trends.
Right, so you can really see how the market is moving.
Absolutely. And don't forget about Zillow. It's great for quick access to property values and rental rates, but make sure to cross-reference with other sites to get a more complete picture.
Oh yeah, it's good to have multiple sources of information.
Definitely. And if you're looking for something more in-depth, I'd recommend checking out some books like The Book on Rental Property Investing by Brandon Turner.
I love that one. It's really comprehensive and approachable.
And there's also Real Estate Investing for Dummies, which breaks things down in a way that's easy to digest. Plus, it covers a lot of ground, from finding deals to managing properties.
Those are great suggestions for anyone just starting out. What about habits?
Well, I think starting small is key. Maybe aim to analyze one deal a week. Set aside a specific time for it. That way, you're continually building your skills without feeling overwhelmed.
That's a really manageable goal.
And joining a local real estate meetup can also be super beneficial. You can connect with others, share insights, and learn from their experiences. Networking can really open doors.
Oh, for sure. It's amazing what you can learn just by talking to other investors.
Exactly. And don't shy away from online forums as well. BiggerPockets has an active community where you can ask questions and share your findings. It's such a supportive environment.
That's a great point. And even just listening to real estate podcasts can keep you motivated and informed, right?
Yes, there are so many out there. I'd recommend checking out the BiggerPockets podcast and Real Estate Investing Mastery. They dive into various strategies and share real-life stories.
Those are both solid choices.
So the key takeaway here is to start where you are. Use these tools, set manageable goals, and connect with others in the community.
Yeah, that's really empowering. It feels like there's a lot of support out there.
Absolutely. With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. So as we wrap up, let's quickly recap some of the key takeaways from our discussion on analyzing rental deals.
Yeah, definitely. First off, I think the biggest thing is understanding your numbers, right? Like, knowing how to calculate your cash flow and expenses is crucial.
Exactly. And then there's the importance of location. You want to invest in areas that not only have potential for growth, but also strong rental demand.
And don't forget about the condition of the property. You really have to assess what repairs or renovations might be needed, as that can dramatically affect your bottom line.
For sure. It's all about seeing the full picture, isn't it? And then, of course, having a solid exit strategy, knowing when it might be time to sell or hold on for the long term.
Right, and I think that speaks to the bigger picture of building wealth through real estate. It's not just about a single property, but how each investment fits into your overall financial goals.
Absolutely. Real estate can be a powerful tool for creating long-term wealth, particularly for those of us over 40 who are planning for retirement or just looking for that financial security.
Yeah, and if you found today's episode valuable, we'd love for you to like and subscribe. And please leave a comment sharing your biggest takeaway or any questions you might have.
And don't forget to share this with someone you know who's looking to dive into property investing. It could really make a difference for them.
Next time, we'll be diving into the differences between cap rate and cash-on-cash return, which is super important for making smart investment decisions.
Sounds great. So thanks for joining us today. And remember, every step you take in real estate is a step toward your financial future.
Yeah. Take care, everyone, and we'll see you in the next episode.